Whoa, the markets just got an absolutely massive jolt. In a really surprising move, the president has announced a new head for the Federal Reserve, and it sent shockwaves all through the financial world. So the big question on everyone's mind is, what does this sudden change actually mean for your money?
And to really get why everyone's freaking out, you just have to look at this one sentence. It captures the anxiety that's gripping Wall Street right now. You see, for more than a decade, investors have played by a certain set of rules. Bailouts, constant liquidity, easy money. And it feels like, as of today, that entire rulebook has just been torn in half.
So how did this all kick off? Well, the shock began the second President Trump confirmed that Jerome Powell was out. The markets, they immediately went into a tailspin. We're talking a dramatic sell-off, not just in stocks, but pretty much across the board.
And let me tell you, the reaction was swift and it was brutal. Stocks started dumping immediately. Precious metals like gold and silver took one of their biggest hits in history. And that whole idea of easy money flowing from the Fed, it suddenly felt like it was just disappearing. The person who got the job was just not who anyone was expecting. Literally overnight, the entire game changed.
And that brings us to the man at the center of this whole storm, Kevin Warsh. So who is this guy, and why is his name alone enough to cause this much chaos?
Well, if you look at his history, it becomes pretty clear why the market is on edge. Warsh was a Fed governor way back during the 2008 financial crisis, and that's where he got this reputation as a hawk. Someone who's really worried about inflation and always favors higher interest rates. He was warning about runaway inflation back in 2010, and get this, in 2011, he actually resigned in protest over a massive stimulus package.
Okay, but here's where the plot really thickens. His past actions are in total contradiction to what he's been saying recently. On one side, you've got the hawk who literally walked away from his job to protest stimulus. But on the other side, you have this guy who's now talking about lowering rates, positioning himself as an ally to the White House. So the market is left scratching its head, asking, which one is the real Kevin Warsh? And this whole contradiction creates what we can call the Trump-Warsh paradox. I mean, why would a president who is constantly loudly demanding lower interest rates go and appoint a famous hawk? Is this a real 180-degree turn for Warsh, or is this just a political calculation to land the top job?
And if you thought that was confusing, check out this quote from before the election. Warsh was out there arguing that for the real economy to do well, the stock market might actually have to come down. I mean, that is the exact opposite of everything the markets have been conditioned to hear for years.
So you take all this confusion, all this contradiction, what do you get? You get the one thing the market hates more than anything else, uncertainty. When investors have no earthly idea if the next Fed chair is a hawk or a dove, they demand to be paid for taking on that extra risk. And how do they get paid? Prices fall. It's as simple as that.
Okay, wow. The present feels pretty chaotic, right? So let's just take a deep breath, step back from the immediate panic, and see what history can teach us about these moments of pure uncertainty.
Okay, this is absolutely crucial. Look at this number, 14.1%. That is the average drop the S&P 500 has experienced within any single year, going all the way back to 1980. Think about that for a second. A drop like the one we're seeing isn't an anomaly. It's a completely normal, expected part of the deal year in and year out. And this chart, it just perfectly illustrates how resilient the market actually is. Even with those average double-digit drops every year, over the last 45 years, the stock market has still finished the year in the green 34 times. The dips are scary, sure, but they're temporary. The long-term trend has been up. And you know what else history gives us? A roadmap for recovery. For a smaller drop, say 5 to 10%, it usually takes about 3 months to bounce back. For a bigger correction, maybe 10 to 20%, you're looking at about 8 months. And even if a drop happens during a full-blown recession, the average recovery is still just 1 to 2 years. The data is clear. Patience gets rewarded. So this all brings us to the most important question, the so what of all this. What is the investor's long game? How do you take all this scary volatility and actually turn it into a real opportunity? Just look at the power of time, right here in these numbers. If you invest for just 1 year, your chance of making a profit is about 75%. Not bad, but stretch that out to 15 years, and your probability of success jumps to 99.8%. It's almost a certainty. It couldn't be clearer. The longer you stay in the game, the less all this short-term noise even matters. I love this quote. It is the perfect way to think about this. I mean, when the price of a TV you want goes down, you don't panic, right? You get excited. You see it as a sale. A market drop is the exact same thing. It's a chance to buy great companies at a discount. It's all about shifting your mindset from fear to opportunity.
So at the end of the day, the strategy, the one that's been proven over and over again, is actually incredibly simple. You buy and you hold for the long term. You learn to see these price drops as opportunities, not threats. And most importantly, you do not let fear and the screaming headlines make your financial decisions for you. Unless you need that money tomorrow, this short-term stuff, it's just noise.
Which really leaves us with one final thought to chew on. When the market is in a full-blown panic and everyone is running for the exits, maybe patience isn't just a passive thing you do. Maybe it's the most powerful active strategy you've got. Maybe it's your superpower.